What if I told you the Federal Reserve just slashed interest rates for the first time this year, but their crystal ball for the economy isn't quite as rosy as some might hope? We're talking about potentially 2 more rate cuts by year-end, a slightly weaker economy, and inflation sticking around longer than their 2% target. Is this the soft landing we've been praying for, or are we heading for a bumpier ride? Let's dive into what the Fed's latest moves really mean for your portfolio, right here on Macro Shock. All right, let's break down the big news that just dropped. Yesterday, on September 17, 2025, the Federal Reserve's Federal Open Market Committee, or FOMC, concluded its latest meeting. And the headline? They voted to reduce the short-term federal funds rate by 25 basis points, bringing the new target range to 4.00% to 4.25%. This marks the first rate cut we've seen in 2025, ending a monetary policy pause that began earlier this year. Mainstream media is reporting this as a risk management cut, rather than a move driven by a fundamental shift in the economic outlook. Chairman Powell himself acknowledged signs of a softening labor market, stating that job gains have slowed and the unemployment rate has edged up but remains low. However, inflation, while easing, remains somewhat elevated. Now, the real meat and potatoes are in their updated summary of economic projections, also released yesterday. The median FOMC participant now expects the federal funds rate to land between 3.50% and 3.75% by the end of 2025, implying 2 more rate cuts, including the one we just saw. Looking further out, they project the rate dropping to 3.25% to 3.50% by the end of 2026. In terms of economic growth, the Fed's median projection for real GDP growth, Q4 over Q4, is 1.6% for 2025, climbing slightly to 1.8% in 2026 and 1.9% in 2027. These are actually a hair higher than their June projections. The unemployment rate is forecast to peak at just 4.5% in late 2025, before gradually declining to 4.2% by 2028. But here's the kicker for your purchasing power. Their preferred inflation gauge, PCE inflation, is expected to be 3.0% in 2025, falling to 2.6% in 2026, and only reaching 2.1% in 2027. This means they don't anticipate hitting their 2% target until 2028. Adding to the complexity, despite the rate cuts, the Fed's quantitative tightening (QT) program is still in full swing, which continues to exert upward pressure on longer-term rates like mortgages. This mixed bag of projections gives us a few paths forward. Let's explore the most probable scenarios and what they could mean for your investments. Scenario 1. Soft landing with controlled disinflation, 60% probability. This is the Fed's preferred narrative. Growth moderates but avoids recession. Unemployment ticks up modestly, and inflation slowly, painstakingly grinds its way back down towards target over the next few years. The Fed successfully navigates the precarious balance of the labor market. We'd likely see the S&P 500 continue its grind higher, albeit with potential volatility as each economic data print is scrutinized. The Nasdaq could lead, fueled by expectations of lower rates benefiting growth stocks. Investor confidence would gradually return, supporting broader market gains. Specific market sectors. This sector stands to gain significantly. Lower interest rates reduce the discount rate on future earnings, making growth stocks more attractive. Companies with strong balance sheets and innovative products would thrive. Consumer discretionary. As inflation eases and employment remains stable, consumers would have more disposable income, boosting spending on non-essentials. Financials. While lower rates can compress net interest margins, a stable economic environment, and a healthy housing market, supported by potentially easing mortgage rates if QT slows, would benefit banks and other financial institutions. Major stocks. Apple, AAPL. Continued innovation and a strong consumer base would likely see its stock perform well, benefiting from a stable economic backdrop and potential valuation bumps from lower rates. Microsoft, MSFT. Its diversified business across cloud, software, and gaming would provide resilience and growth, particularly as enterprises continue digital transformations. JP Morgan Chase, JPM. A robust economy would translate to strong lending activity and manageable credit risk, allowing JPM to maintain solid earnings. Scenario 2. Stagflation light. Stubborn inflation, weaker growth, 30% probability. In this scenario, inflation proves more persistent than the Fed anticipates, perhaps due to ongoing supply chain issues, geopolitical tensions, or stronger than expected wage growth, even as the economy slows more than projected. The Fed is forced to keep rates higher for longer, or even reverse course on cuts, choking off growth. This scenario implies a range-bound market with increased volatility, or even a slight downturn. Investors would be caught between persistent inflation eroding earnings and weakening demand. Defensive sectors would outperform, and value stocks might gain favor over growth. Specific market sectors. Energy. If inflation remains elevated, commodity prices, including oil and natural gas, would likely stay strong. Energy companies would benefit from higher prices and continued demand, acting as a natural inflation hedge. Utilities. These are classic defensive stocks. Their stable dividends and regulated earnings streams make them attractive during uncertain times. Consumer staples. Demand for essential goods remains relatively inelastic, making companies in this sector more resilient to economic slowdowns. Major stocks. ExxonMobil, XOM. As a major oil and gas producer, XOM would be a direct beneficiary of sustained high energy prices due to inflation. Coca-Cola, KO. Its global brand power and essential product offerings make it a reliable performer in a stagflation-light environment. NextEra Energy, NEE. A leading utility, NE's regulated earnings and focus on renewable energy would provide stability and long-term growth prospects. Scenario 3. Deeper than expected slowdown/mild recession, 10% probability. The Fed's risk management cut might be too little too late. The economy could tip into a mild recession as the cumulative effect of past tightening catches up, alongside weakening consumer demand and corporate earnings. This would be a significant risk-off event. The S&P 500 and NASDAQ would likely experience substantial downturns as corporate earnings get hit, unemployment rises, and consumer confidence plummets. Specific market sectors. All sectors would be negatively impacted, but cyclical sectors, e.g. industrials, consumer discretionary, technology, would be hit the hardest. Defensive sectors, utilities, healthcare, staples, would relatively outperform but still likely see declines. Major stocks. In this scenario, broad market ETFs like SPY and QQQ would suffer considerable losses. Even mega-cap tech, while potentially more resilient than smaller firms, would face significant headwinds from reduced consumer and enterprise spending. Companies with high debt or reliant on discretionary spending would be particularly vulnerable. So, what's Dave doing with all this information? My take, right now, is one of cautious optimism, leaning towards Scenario 1, but with a keen eye on the risks of Scenario 2. The Fed's projections show a path to slowing inflation and modest growth, which is a soft landing, even if it takes longer to hit their inflation target. The rate cut is a positive signal, showing they are reactive to potential downside risks to employment. However, the elevated uncertainty and disagreement among FOMC members about future cuts mean we can't be complacent. I'm not blindly buying everything, but I'm certainly not running for the hills either. I'm looking for quality companies with strong balance sheets and pricing power, those that can weather a bit more economic choppiness if inflation proves stubborn. Now, let's turn to the charts, specifically the SPY, our proxy for the broader S&P 500. The technical picture right now tells us that SPY is in an uptrend, and after hitting resistance at around 660 is in a consolidation. What does that mean for us? It means the overall momentum is still positive, but we've seen some hesitation at that 660 level. This consolidation phase is critical. Are we building energy for a breakout higher, signaling that the market is digesting the Fed's news positively and ready to resume its climb? Or is this consolidation a precursor to a breakdown, indicating that the market views the Fed's projections as insufficient or too slow, potentially leading to profit-taking or a deeper correction? I'll be watching that 660 resistance level very closely. A decisive break above it, especially on strong volume, would be a bullish signal. Conversely, a failure to hold current support levels within this consolidation would signal caution. In this environment, I'm selectively adding to positions in high-quality tech names that have strong earnings and free cash flow, while also maintaining exposure to some defensive sectors as an inflation hedge. It's about balancing growth potential with risk management. What do you think about the Fed's latest move and their economic outlook? Are you betting on a soft landing, or are you preparing for something tougher? Let me know your thoughts in the comments below. And if you're getting value from this analysis, please hit that subscribe button and ring the notification bell so you don't miss our next Macro Shock episode. Remember, this is not financial advice, just my analysis and perspective as the host of Macro Shock. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Your capital is at risk.